Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. So far 18 problems I have completed on this topic of CVP analysis. In this video 5 more problems I'm going to explain from 19th problem onwards, and every problem will be a different problem. Remember, we don't know which type of problem will be asked in the examination. So you should watch all the videos, every problem carefully with full concentration, and keep a notebook, calculator, pen ready while watching the video to record, to note down the formulas, the procedure, the process, the meaning, like that. Then only we can be able to explain, understand well. Now 19th problem. Before starting the 19th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So always keep ready. Take the screenshot of the points written on the board, then I'll explain every point in detail. Now 19th problem. See the 19th. The sales and profit for 2016 and 2017 are as follows. Again, 2 years data is given, sales are given and profit is given for 2016 and 2017. Find out PV ratio, BEP, sales for a profit of 40,000, profit when sales are 2,50,000, and MOS at a profit of rupees 50,000. So this problem is again a straightforward problem, and this type of problems already we have done in the previous video. Now year 2016-2017, sales are given 1,50,000, 1,70,000, profit 2025. You know, whenever 2 period data is given, we have to apply the formula for PV ratio, change in profit by change in sales into 100. So how much is the change in profit? 20,000 to 25,000. 5,000 rupees is the change in profit. And sales from 1,50,000 to 1,70,000. So 20,000 is the change in sales. So 5,000 by 20,000 into 100, 25%. First item, PV ratio we have completed. Now secondly, we have to calculate the BEP. But for calculating BEP, we need the fixed cost. Without fixed cost, we cannot calculate BEP. So by applying the PV ratio formula, we find out the fixed cost. So here PV ratio is equal to C by S. In place of C, I am writing F plus P. Actually, C stands for contribution. Contribution can be found out by applying S minus V or F plus P. But we need fixed cost. That's why I am writing F plus P by S, right? PV ratio 25%. It is in percentage. So if you take 25 here, then you should multiply into 100, multiply by 100 here, percentage. But if you take fraction instead of 25, 25% means 25 by 100. 25 by 100 means 0.25. So we can write 0.25 or we can write 25. If you write 25, multiply by 100. If you write 0.25, don't multiply by 100. So here PV ratio is 0.25. Now fixed cost we don't have, we have to calculate. Whereas profit, take any one of the year's profit. Then I have taken the profit of 20,000 of the first year. Then sales should also be for the same year. First year sales 1,50,000. So 20,000 divided by 1,50,000. So now cross multiplication, F plus 20,000 is equal to 0.25 into 1,50,000. So I am making a cross multiplication like this here. Then what will happen? F plus 20,000 into 1 is F plus 20,000. Then 0.25 into 1,50,000, you will get 37,500. Right? Now bring this 20,000 to RHS. Plus 20,000 will become minus 20,000. So 37,500 minus 20,000, 17,500. So we got the fixed cost to 17,500. Now BEP, easily we can find out fixed cost by PV ratio. The fixed cost 17,500, PV ratio is 0.25. So BEP will be 70,000. So we got PV ratio, we got BEP. Third, C point. Sales required to earn a desired profit of 40,000. In so many problems, we have applied the formula sales required to earn a desired profit. Fixed cost plus desired profit divided by PV ratio. So fixed cost 70,000. Fixed cost is 17,500 and desired profit 40,000. PV ratio 0.25. So 40 plus 17,500, 57,500 divided by 0.25, 2,30,000 is the sales required to earn a desired profit of 40,000. ABC, 3 bits completed. Now fourth bit, profit is equal to how much when sales are 2,50,000. If the sales are 2,50,000, how much would be the profit? Again, this type of problems we have done already. By using PV ratio, we can find out, right? So PV ratio is equal to C by S. In place of C, I am writing F plus P because I require profit, right? F plus P. 0.25, PV ratio is 0.25. F fixed cost, already we have calculated 17,500 is the fixed cost. Profit, we have to find out. What is the profit? We have to find out. And when sales are 2,50,000, denominator sales 2,50,000. Again, I am making a cross multiplication like this. Then what will happen? 17,500 plus P into 1 is 17,500 plus P. 0.25 into 2,50,000, you will get 62,500. Now, bring the 17,500 to RHS. So, plus will become minus. So, 62,500 minus 17,500, 45,000 is the profit. When sales are 2,50,000, the expected profit is 45,000. That's it. Last E point. How much is the margin of safety at a profit of rupees 50,000? So, there are two formulas for margin of safety. MOS is equal to actual sales minus BP sales or profit by PV ratio. Here we are given the profit. That's why I am writing profit by PV ratio, profit 50,000, PV ratio 0.25. We'll get 2 lakh. MOS 2 lakh. Finished. So this is the end of problem number 19. Now, problem number 20. The 20th problem. From the following data, which product would you recommend to be manufactured in a factory? Time being the key factor. This is important. This problem is important from examination point of view. This problem is of key factor or limiting factor. In examination, you may be asked, explain about key factor or limiting factor, and problems will also be there. So already I explained in the theory video. If you have not watched that video, I suggest you go to the playlist of my channel. Select the subject financial decision making. Select the video number 4, theory video 4, where I have explained you all the different concepts like key factor or limiting factor, make or buy decision, etc. Right? So key factor or limiting factor is that factor which limits the activity of the business, which limits the production of the business, which limits the profitability of the business. Every business is confronted with one or the other factor which stops the production. Example, in some business, material may be in shortage. The material is the key factor. In some business, material is in plenty, but labor time is not there. It is stopping the production. The labor is the time factor. In some business, material, labor, everything is there, but finance, capital problem is there. Lack of capital. So capital is the key factor, right? So here in our problem, it is given time being the key factor. Now information given, product A per unit, product B per unit, direct material, direct labor, variable overhead, selling price, and standard time to produce. The standard time to produce 1 unit is 2 hours for product A and 3 hours for product B. This is the information given. We are required to recommend the company which product is more profitable. A product is profitable or B product is profitable. Time being the key factor, right? One point you remember, if there is no limiting factor or key factor, that product is more profitable whose contribution per unit is more. Whichever product has more contribution per unit, that product is more profitable, right? But when there is key factor, we have to calculate contribution per unit of that key factor. Here key factor is time. Key factor is time. Hours. Hours are the key factor. So we calculate what is the contribution per hour. Right? Now see, selling price per unit is given 100 rupees per unit for A, 110 rupees per unit for B. Selling price. Now variable cost consists of direct material, direct labor, variable overhead. These three are the variable cost. If you add up, 30 is the variable cost for A, 23 is the variable cost for B. And you know contribution means selling price minus variable cost. SP minus VC. So 100 minus 30, 70 is the contribution per unit. 110 minus 23, 87 is the contribution per unit. So if there is no limiting factor, product B is profitable. Because every unit is giving a contribution of 87 rupees. More contribution. Product B is better if there are no limiting factor. But in our problem, time is the limiting factor. So standard time to produce 1 unit is 2 hours. After 2 hours, we are getting 70 rupees. And standard time to produce is 3 hours. After 3 hours, we are getting 87 rupees. Now we calculate contribution per hour. The contribution per unit divided by standard time. So 70 divided by 2, 35 rupees per hour contribution. 87 divided by 3, 29 rupees is the contribution per hour. So whichever product has more contribution per hour, that product is suggested, recommended, profitable. So here 35 rupees is the more contribution per hour which we get from A product. So final answer is we suggest the company to go for product A since it gives more contribution per hour. That's it. So here I have written the contribution per hour is equal to contribution per unit divided by standard time to produce 1 unit. So here contribution per unit is 70 divided by 2, 35. 87 divided by 3, 29. Right? Since time is the key limiting factor or key factor, that product is more profitable whose contribution per hour is more. So hence product A is more profitable because every hour we are getting 35 rupees contribution. That's all. Now 21st problem. Sales are 2 lakh. Then profit is 20,000, variable cost 60%, you are required to calculate PV ratio, fixed cost, sales volume to earn a profit of 50,000. Straightforward problem. So sales 2 lakh, profit 20,000, variable cost is 60% of sales. So 60% of 2 lakh, it comes to 1 lakh 20,000. So first we can calculate PV ratio. C by S. S minus V by S because we have sales 2 lakh, variable cost 1 lakh 20,000. So 80,000 by 2 lakh into 100, it comes to 40%. We got the PV ratio. Now fixed cost PV ratio is equal to C by S, F plus P by S. Now PV ratio we got 0.4. Fixed cost we need to calculate profit. Profit is given in the problem 20,000. And sales are given in the problem 2 lakh. Cross multiplication F plus 20,000 is equal to 0.4 into 2 lakh, 80,000. Take this 20,000 RHS, fixed cost is 60,000. Now substitute fixed cost. It is asking you to calculate the fixed cost. We have calculated. Now thirdly, it is asking you to calculate sales volume to earn a profit of 50,000. I think I have not calculated here, but you have to calculate yourself. Sales volume to earn a profit of 50,000 means sales required to earn a profit of 50,000. So formula is same. Here we have written sales required to earn a desired profit of 40,000. Same formula, fixed cost plus desired profit divided by PV ratio. Here also you do the same thing. Fixed cost is 60,000 plus desired profit is 50,000. So 60 plus 50, 1 lakh 10,000 divided by PV ratio is 0.4. So 1 lakh 10,000 divided by 0.40, that will give you sales required. That's all. So this is the end of 21st problem. Now 22nd problem. This 22nd and 23rd, these two problems are on make or buy decision. So this make or buy decision is very, very important from examination point of view. So watch with full concentration this make or buy decision. So sometimes a company, a business is confronted with a problem whether to make the component ourselves within the company or should we buy it from the outside supplier. This is called make or buy decision. So here a company finds that while it costs 6.25 rupees 6.25 each to make component X, the same is available in the market at 5.75. So to make within the company it is 6.25, but the same component is available in the market 5.75 each with assurance of continued supply. Now directly we cannot compare that supplier price is 5.75 and our own cost is 6.25. If you compare this, you will think that 5.75 is less, so it is better to buy it. No, we have to find out the breakdown of our cost. The cost is 6.25. How do we got that 6.25? What are the elements of this 6.25 that we need? The next page it is given the elements of cost. Material 2.75 per unit, then labor 1.75, other variable cost 0.5, other fixed cost 1.25, and total cost is 6.25. So here breakup is given for 6.25. Now, should you make or buy? First question. Second, what should be your decision if the supplier offers the component at 4.85? So instead of 5.75, the supplier has agreed to give you at 4.85. But that is the second question. The first question is whether we should make it or buy it. Now, first of all, we need what is the variable cost per unit. Don't take fixed cost. So here variable cost material 2.75, labor 1.75, other variable cost 0.5. So variable cost per unit comes to 5 rupees. We have not taken into account the fixed cost. We have ignored the fixed cost, only variable cost. 5 rupees. Supplier price per unit is 5.75. Now compare it. 5 rupees variable cost, 5.75 supplier price, which is less. The variable cost is less. Since the variable cost is less than supplier price, we suggest the company to to produce the product ourselves. Don't buy it from outside. It is costly. Whether it is cheaper to make the product ourselves. Here I have written. Since variable cost per unit is less than the supplier price, so it is suggested to make the product and don't buy it from outside. The fixed cost should not be considered in make or buy decision, since it has to be incurred whether we make it or buy it from outside. This point you have to remember. In examination, the complete explanation you have to give. First, you compare variable cost with supplier price and give the decision. After giving the decision, explain that fixed cost should not be considered in make or buy decision because it is irrelevant. Whether we make it or buy it, we have to incur the fixed cost, right? So the fixed cost should be ignored. Now second, if the supplier has reduced the price to 4.85, then what is the decision? Now you compare variable cost 5 rupees, supplier price 4.85. So in this case, supplier price is less than variable cost. We suggest the company to buy the product from the supplier. Don't make it, because it is costly to make 5 rupees, whereas the same is cheaper in the market 4.85. So in this situation, we suggest the company to buy it from outside. The component, then it has to be purchased from outside since the supplier price is less than the variable cost. That's all. This type of problem will be frequently asked in examination. Next. 23rd. Following information relates to Coromandel Company Limited, which produces washing machines. Company produces washing machine. Cost per unit, material 50 rupees, labor 25, direct expense 15, fixed expense 10, profit 20, selling price 120. The production capacity of the factory is 10,000 units. At present, the supplier has offered the same item for rupees 95. Should the company produce the item or buy it from the outside supplier? Give reasons. Again, this problem is also on make or buy decision, right? We compare the variable cost with the supplier price. The variable cost are material 50, labor 25, direct expense 15, variable cost is 90. We have not considered the fixed cost or profit or selling price. We have ignored. We need only variable cost. Supplier price 95. Supplier price 95, whereas our making cost, variable cost is only 90. So we suggest the company to make the product, make the component, don't buy it from outside. Since the variable cost per unit is less than the supplier price, so it is suggested to make the product. The product should not be purchased from outside. Again, you should write the fixed cost should not be considered in make or buy decision, because the fixed cost must be incurred whether we make it or buy it. So it is irrelevant cost. It should be ignored. Now, since it has to be ignored, now the company will save 50,000 rupees because 10,000 units the company requires. So each unit, the difference is 5 rupees. The supplier price is 95, whereas variable cost is 90. So 5 rupees we are saving by making the product ourselves. So 10,000 into 5, 50,000 rupees the company will save by making the product and not buying it from outside. That's all. This is the end of problem number 23. So totally 23 problems I have completed on this CVP analysis. Inshallah, we will continue the next problem in the next video. So if you are satisfied, give a like to the video. Share my channel. Subscribe if you have not yet subscribed. Give your comments. And lastly, buy the super thanks which is given below my video. Inshallah, we'll continue the next problem in the next video.